In 1972,
Warren Buffett paid $25 million for a small candy company in California.
its book value? About $8 million.
He paid more than 3 times the company's accounting worth, and it became one of the greatest investments of his life.
So why did he break the cardinal rule of value investing? The answer is the gap.
Every stock has 2 prices.
The one the market shouts at you every second, and the quiet one buried in the balance sheet. Most investors only look at the loud one.
But the gap between those 2 numbers, that's where the real story lives.
It tells you what the market believes about a company's future.
It tells you when investors are dreaming, and when they're terrified. By the end of these next 8 minutes, you'll know exactly how to read that gap. And the third reason it appears is the one that fooled an entire generation of bankers in 2008.
Let's start simple. Book value is what's left over if a company sold every asset it owns and paid off every dollar it owes.
Buildings, inventory, cash, equipment, minus debt, minus payables.
Whatever remains belongs to shareholders. That's book value. Market value is different. It's just the share price multiplied by the total shares out there.
It's what investors are willing to pay, right now, for the whole pie. When you divide market value by book value, you get the price-to-book ratio.
P/B.
And this single number has been the value investor's compass since Benjamin Graham first wrote about it in 1934.
Graham's rule was strict.
He wanted to buy companies trading below their book value. Sometimes, below their net working capital alone. He called these net-nets. Pay 50 cents for a dollar of accounting assets, and you have a margin of safety baked right in. But here's where things get interesting. The world Graham invested in barely exists anymore. Today, the average S&P 500 company trades at roughly 3 times book value. Some trade at 50 times.
Why? 3 reasons. First, intangibles.
In Graham's day, companies were factories, railroads, steel mills.
Their value lived in physical things you could touch.
Today, the most valuable companies on earth own almost nothing physical.
Apple's brand. Microsoft's software. Google's algorithms.
None of it sits on the balance sheet at full value.
Second, expectations. Market value isn't about what a company is worth today. It's about what investors believe it will earn over the next 20 years.
A high price-to-book ratio means the market expects future cash flows to dwarf the current asset base.
Third, accounting limits.
Book value is calculated by rules written for a different era.
It penalizes share buybacks. It writes off research and development as expense. It can't measure customer loyalty or network effects. So the number itself has blind spots.
That's why Apple trades at over 50 times book value, and a steel mill trades at 1.
The market isn't crazy. It's pricing things the accountants can't see.
But just because the gap can be huge, doesn't mean it should be.
Sometimes, the gap is a warning. Now here's where the real money gets made. The gap can swing in your favor. Hard. Think back to 2008. Major American banks, Wells Fargo, JP Morgan, Bank of America, were trading well below their book values. Investors were panicked.
They assumed the assets on bank balance sheets were worth far less than reported.
Some were right. Many were wrong. Buffett saw the gap.
In October 2008, he invested $5 billion in Goldman Sachs. By 2011, that position had returned over $3 billion in profit.
The lesson?
When fear pushes a quality company below its book value, you're often being handed a discount on real, productive assets.
That's Graham's margin of safety in action.
But, and this matters, the strategy only works if the book value itself is honest.
In 2018, General Electric wrote down $22 billion in goodwill alone.
Goodwill is what a company carries on its books after paying more than book value for an acquisition.
GE had been carrying inflated numbers for years. The market knew it. The accountants finally caught up.
This is the trap with low price-to-book stocks.
Sometimes a stock looks cheap on paper because the paper is wrong. The assets are obsolete. The buildings are crumbling. The inventory can't be sold. The book value is fiction.
Charlie Munger, Buffett's longtime partner, saw this clearly decades ago.
He pushed Buffett past Graham's pure asset-based approach. Munger said, "It's better to buy a wonderful company at a fair price than a fair company at a wonderful price."
That's why Buffett paid 3 times book value for See's candies in 1972. The book didn't capture the brand. It didn't capture the pricing power.
It didn't capture the loyal customers who would pay any price for a heart-shaped box every February.
See's has since generated over $2 billion in pre-tax earnings on that $25 million investment.
The book was wrong. The market was right. And Buffett knew the difference. So here's the principle to carry with you. Book value is the floor. Market value is the ceiling. The gap between them is a story. A small gap means investors don't expect much.
A huge gap means investors expect a great deal. Your job as a value investor is to ask one question.
Is the gap justified by the business or distorted by emotion? When you can answer that question honestly, you're no longer guessing at stock prices. You're reading what the market believes. And that's the moment you stop being a speculator and start being an investor. Here's a question for the comments. What's a company you own or watch where you think the gap between book value and market price is telling a story? I read every comment. And if this helped you see the market a little more clearly, hit subscribe. Tomorrow we're sitting down with one of Buffett's quietest partners.
Someone you've probably never heard of, who shaped his thinking more than almost anyone.
You won't want to miss it. Remember, this is educational content, not financial advice.
Always do your own research before you invest $1.